Welcome. This short video, we're going to just talk about how to finance your business. And the two traditional ways is debt and equity. And so we're just going to run through some of the benefits and the disadvantages of using debt versus equity. So debt is generally when you're getting money borrowing money from the bank, whether it's a commercial bank, whether it's a private lender, just someone who is lending you money and you have to pay it back at a certain interest rate and within a certain time. So one of the benefits of getting debt is you're not losing any ownership or control over the business. They aren't. They're not making financial decisions, or they can't make decisions. So you're not losing control. However, it must be repaid, and so you've got to repay the loan. It doesn't matter how much sales that you're making, you still need to repay the loan. And so that opens you up to some risks. So one of the risks is the interest rates changing. We've been in a low interest rate environment for a while now. If things start to change, it can have big ramifications on a business, especially the small business. And we spoke about in a previous video about building a strong balance sheet is about understanding how much you leverage. Another thing is that the actual lender may say, well, you're too much of a risk now, you've got to pay the money back, or you've got to pay it back at a higher interest rate. So you're open to higher risk that way. Debt is also considered cheaper, and one of the reasons for that is that you're able to claim the interest as a tax deduction. So you borrow $100,000, your first year you may pay $10,000 in interest, as I say, at 10%. Then you claim a tax deduction of $10,000, so that's saving you, let's say, $3,000 in tax, which then leads into it reduces your profitability. So that $10,000 in interest that you've paid, it's reduced your net profit by $10,000. Conversely, equity is when an owner or a group of owners have purchased or have put money into the business to get the business going, or to supply capital for the business. And so and they're going to expect a return on that investment, whether it's through distributions like dividends or when they sell the business. Let's just run through their advantages. One of the advantages it has is that if you've got a good equity partner, they might have good influence, connections, and experience, and so that may open up doors for the business that you did not have opportunities before. However, you might start losing control of your business, and so depending on how much equity they take, or even if they take a little bit, when you start having board meetings, you're going to lose some control over your business. So that's another thing to weigh up. As opposed to having to repay the loan, you have flexibility in distributions. So you don't have to pay back money from your profit in dividends or anything. You have flexibility in that. So it reduces your risk. So it doesn't matter if your sales go down, you just don't distribute some of the money back. The other thing is there's potentially more cash available. So where you have to get a loan, you have to show your financial reports, and there'll be a limit that the bank is willing to lend you. When it comes to equity investors, it really comes down to how much risk the investor is willing to take on. So here are some just advantages and disadvantages of debt and equity in your business.